Okay, so let's unpack this. Because if you look at a traditional salary from a purely mathematical perspective, it's essentially just a fixed rate bond.
Right, exactly.
You're guaranteeing a specific output of your time and energy, and in exchange for that, you get a capped, totally predetermined yield.
Yeah, your upside is strictly limited.
Exactly. It doesn't matter if the company's revenue doubles or like triples while you're there. Your yield stays exactly the same. You're
Yeah.
putting in all this sweat to power the engine, but structurally speaking, you have zero access to the actual upside.
Which is, entirely by design. The modern paycheck system we're analyzing today was never engineered to actually make you wealthy.
Not at all.
It was built for compliance. I mean, it's meticulously calibrated to keep you manageable. You're just productive enough so you don't quit, but never financially free enough to, actually walk away.
And that's our mission for you on this deep dive. We're looking at a remarkably blunt breakdown from entrepreneur Mark Cuban, all about the mathematical architecture of true wealth building.
It's a fascinating look at the numbers.
It really is.
Yeah.
We're going to tear down exactly how you escape this cycle of relying on a salary. Because look, if you're listening to this, you probably already know the traditional financial advice, the whole work hard, save a little, retire at 65 playbook is just functionally obsolete.
Honestly, it's worse than obsolete. It's a trap.
Okay, correct.
Yeah, because we're trained from childhood to view a high salary as the ultimate goal. Guidance counselors, parents, universities, they all sell this narrative that a degree leading to a stable W-2 income is how you build a life.
Right.
But when you actually look at the underlying corporate accounting, a paycheck is a ceiling. It is not a ladder.
Right, because when you're working for a salary, you are fundamentally just selling your time at a fixed rate. I like to think of it as like running on a treadmill where someone else completely controls the speed and the incline.
That's a great way to put it.
You can sprint as fast as humanly possible. You can optimize your stride. You can burn yourself out putting in 80-hour weeks, but you aren't actually moving forward into ownership. You're just running in place to keep someone else's machine powered.
And if we connect this to the bigger picture, it really comes down to how a business classifies you. When you work for a paycheck, you are an expense on an income statement.
Ouch.
I know, but it's true. The company is working for profit. You are the cost of generating that profit. Even if you, negotiate a massive raise or get a huge promotion, there's a hard mathematical cap on your value.
Because paying you more directly reduces the company's bottom line.
Exactly. The company takes its profit first, and you get whatever is left over from the labor budget.
That is a brutal way to look at it, but it's entirely accurate. You're an expense. You are literally a line item they are constantly trying to minimize.
Yeah. And the real tragedy is what happens with the money people do take home. There's this illusion of stability in the modern economy that completely masks systemic vulnerability.
Oh, for sure.
Take the data point from the sources regarding auto loans. The average American right now has a car payment of $767 a month.
Wait, almost $800 a month? Just for a car?
Yeah, just the car.
That is a massive drain on monthly cash flow.
It is. But here's the crazy mathematical disconnect. While they're servicing nearly $800 a month in debt for a depreciating asset, statistically, that exact same household couldn't produce $1,000 in cash for a sudden emergency.
Without going into high-interest credit card debt, you mean?
Exactly. They're running with zero shock absorbers.
The sources describe a very specific, vivid scenario that honestly kind of haunts me. They talk about a 47-year-old sitting in a cubicle who's worked 20 hard years, climbed the middle management ladder, but still can't survive a single missed payroll cycle.
Yeah, that part was heavy.
The phrasing used is incredible. It calls that exact scenario a hostage situation with a dental plan.
A hostage situation with a dental plan, it perfectly captures the dread of it, doesn't it?
It really does.
Because one missed paycheck, one medical anomaly, one major car repair, and the entire foundation just collapses. And the differentiator between that person and someone with actual wealth isn't just, a higher salary.
Wow.
It's the type of income they generate. Wealthy people don't work for a paycheck. They work for profit.
Okay, let's break down the mechanics of that, because working for profit sounds like a bumper sticker until you actually look at the math. How does profit behave differently than a salary?
Well, two main ways. First, profit compounds and operates completely independently of your time.
Like it pays you while you sleep.
Exactly. While you sleep, while you're on vacation, while you're sick, it's totally decoupled from your physical labor.
Wow.
And second, and perhaps more importantly, profit is taxed differently.
Oh, right. The tax code.
Yeah, in our system, capital gains and qualified dividends, which are the fruits of profit, are taxed at a significantly lower rate than earned W-2 income. The tax code structurally rewards capital deployment over physical labor.
So you're either a piece of the profit machine or you're fuel for someone else's. There's no magical middle ground where you safely W-2 your way to generational wealth. The map literally prohibits it.
It really does.
So if we know we have to make this transition, how do we actually execute it? Because Mark Cuban's framework doesn't just rant about the problem. It provides a highly rigid mathematical architecture for getting out.
Right. It introduces 3 numbers that dictate your entire cash flow: 75, 15, and 10.
The 75, 15, 10 architecture. Break that down for me.
So this is the operational filter for every single dollar you earn. First, 75 cents of every dollar is the absolute hard stop maximum you are permitted to spend on your life.
Like everything.
Everything. Rent, groceries, that absurd car payment, streaming services, flights, everything combined cannot exceed 75% of your take-home pay. It's a structural limit.
Okay, I need to push back on this right away because I can hear you listening right now thinking, well, how on earth am I supposed to cut my spending by 25% when inflation is crazy and I'm already living paycheck to paycheck?
Yeah.
That just sounds mathematically impossible for a lot of people.
I get that. It sounds impossible until you reframe the stakes. The framework anticipates this exact objection with a pretty harsh reality check.
What's the check?
Imagine if you woke up tomorrow and the federal government announced a mandatory 25% tax increase on your specific income bracket. What would you do?
I mean, I'd lose my mind. I'd be furious.
You'd be furious, sure, but ultimately you would figure it out. Because the alternative is tax evasion and prison.
That's a fair point.
You would suddenly find a way to cancel the subscriptions you don't use. You'd stop eating out 4 nights a week. You'd downgrade the car. You'd find the 25% because the consequences of not finding it are absolute and immediate.
The difference being, in this scenario, you aren't sending that 25% into some government black hole. You're sending it to your future self.
Well,
You're treating your own financial liberation with the exact same urgency as a federal tax mandate.
precisely. It's an investment in the only entity that is perfectly aligned with your interests. So, if 75% is the lifestyle cap, the next 15% goes directly to investing.
Okay.
That's the capital you use to purchase your freedom, buying to that profit machine we talked about. And then the final 10% is routed into cash savings.
Which acts as that shock absorber we mentioned earlier. This is the buffer, so you don't have to swipe a Visa at 24% interest when the transmission blows on your car.
Exactly.
But this isn't an infinite savings bucket, right? There are very specific targets here.
Correct. Because cash loses value to inflation, so you only hold exactly what you need to mitigate risk. The target is 3 to 6 months of total living expenses if you're young, single, and have no dependents.
And if you have a family,
If you have people relying on your income or you work in a highly volatile industry, you push that cash reserve to 6 to 12 months.
got it. And once you hit that fully funded threshold, the math shifts.
Yeah.
You don't just keep piling cash into a high-yield savings account. You take that 10% savings allocation and redirect it into your investing bucket.
Right.
So now you aren't just investing 15%, you're deploying 25% of your income into wealth-building assets.
That is the inflection point. That's when you shift from playing financial defense to playing aggressive offense, and the compounding velocity really takes off.
Oh, wow.
But there's a massive infrastructural roadblock here that derails almost everyone who tries this. The entire 75-15-10 architecture will catastrophically fail if you try to manage it out of one single checking account.
Yeah, the sources make a great comparison here. It's like trying to run 3 completely different businesses out of one single cash register and then acting shocked when you don't know which money belongs to whom.
It's an accounting nightmare.
It really is. You need
Yeah.
3 distinct bank accounts.
A spending account, an investing account, and a savings account. It's about creating intentional friction. And more importantly, you have to completely automate the flow of capital between them.
Okay, let's talk about the mechanics of that automation because it seems to be the linchpin of the whole strategy. Why is manual transferring such a guaranteed failure?
Because it relies on willpower. And willpower is a biological resource that depletes throughout the day. If you wait until the end of the month to manually transfer whatever is, left over into your investments, you will consistently find that nothing is left over.
Sure.
Your prefrontal cortex is exhausted by the end of the day. The framework points out that willpower completely collapses at 11 p.m. when you're exhausted, scrolling on your phone, and a targeted ad hits you with a 40% off sale.
Oh man, the 11 p.m. algorithm knows exactly when your defenses are down. It's predatory.
It really is. So automation removes your flawed, emotionally exhausted human brain from the equation entirely.
You just take yourself out of it.
Exactly. You set up the routing so that the very second your direct deposit hits your main account, the 15% and the 10% are immediately drafted into their respective accounts.
It happens before you even open your banking app.
Yes. Before your brain can even register that you have new money to spend, the capital is already deployed.
The system doesn't have bad days. The system doesn't care about a flash sale. It just executes the math.
Right.
Okay, so structurally, we have the infrastructure automated, the 3 accounts are set up, and we've got 15%, eventually 25% of your income consistently flowing into an investment account. Now we have to talk about capital deployment. How do we actually buy into this profit machine?
Well, the material outlines 3 primary avenues to access profit. The first is building a business from scratch.
Which, to be fair, they admit is a brutal path.
Oh, it is. It's the most direct path to owning 100% of the profit, but the failure rate is staggering.
Yeah.
It requires extreme hours, relentless stress, and a high tolerance for risk. It's really not the recommended starting point if you're just learning how to deploy capital.
Right, so if I want access to profit, but I don't want to blow up my life and work 90-hour weeks building a startup, what's my second option?
The second option is equity or profit sharing at an existing job.
Okay, here's where it gets really interesting. Because if you're working in tech, biotech, or any high-growth sector, the actual base salary they offer you might be the least mathematically significant part of your compensation package.
It's a critical paradigm shift. Look at the early employees at companies like Amazon, Google, or Stripe.
Right.
They didn't build multi-million-dollar net worths because their bi-weekly W-2 checks were slightly higher than the industry average. They got wealthy because they negotiated for equity.
They demanded a fractional piece of the profit machine they were actively building.
Exactly. They owned the upside. And the framework argues pretty aggressively that if your current employer offers absolutely zero path to profit participation, no equity, no stock options, no performance-based profit sharing, you have to legitimately question whether that company deserves your most productive years.
Which leads us to the third way to access profit. And this is the most universally accessible path for everyone listening, the public stock market.
Yes.
But we have to fundamentally reframe what the stock market is, because the cultural narrative treats it like a casino. People think it's just arbitrary lines on a graph going up and down based on luck and vibes.
But it's not a casino. Mechanically, it is a marketplace where you can deploy your capital to buy fractional ownership of actual profit-generating businesses.
Okay.
When you own a share, you own a fraction of that company's profit. You
Right.
capture that value either through the asset appreciating in price or through the company distributing that profit directly to you via dividends.
But the framework is very opinionated about how you participate in this marketplace. It strongly advocates for passive index investing over active stock picking.
It does.
Let's actually define the mechanism here, because people throw around terms like ETF and index fund constantly without explaining how they actually work.
Sure. So passive investing means you acknowledge that you don't have the insider edge to pick the single next winning stock. You aren't trying to find the needle in the haystack. You're just buying the entire haystack.
I love that analogy.
Right. And an ETF, or exchange-traded fund, is essentially just a basket of stocks. When you buy one share of an ETF, your money is instantly and proportionally distributed across hundreds or even thousands of companies.
For example, the sources specifically mention a fund called VTI. When you buy VTI, you aren't guessing which company will win. You are buying fractional ownership in over 2,000 publicly traded U.S. companies simultaneously.
Exactly.
You're essentially just betting that the broader U.S. economy will continue to generate profit over the long term.
Or SPY, which tracks the S&P 500, the 500 largest companies in the U.S. And what's brilliant about the underlying mechanics of SPY is that it's self-cleansing.
Self-cleansing. How so?
Well, if a company in the top 500 starts failing and its market cap drops, it is automatically removed from the index and replaced by a growing, stronger company.
Oh,
Yeah, you don't have to lift a finger to rebalance your portfolio. The index naturally fleshes out the losers and promotes the winners.
and if you have a higher risk tolerance, there's QQQ, which gives you concentrated exposure to the top 100 non-financial companies. It skews incredibly heavily toward massive tech monopolies.
Right.
Structurally, that means it's highly volatile. It's going to swing up aggressively during bull markets, and it's going to plummet much harder during downturns.
Which is perfectly fine as long as you understand the mechanics of volatility and don't panic. But the fund we really need to highlight from the breakdown is SCHD.
Oh yeah, SCHD.
This is designed for investors prioritizing cash flow. SCHD filters for companies that have paid consistent dividends for a minimum of 10 consecutive years.
Let's pause on that 10-year rule, because that's not just a random number. Why does a decade of consistent dividend payments matter so much?
Because a 10-year requirement acts as a brutal stress test for corporate durability. I mean, think about what happens in any 10-year economic window.
Right. Recessions, supply chain collapses.
Exactly. Inflation spikes, geopolitical crises. If a management team can consistently pay out a portion of their profit to shareholders every single quarter through all of those macroeconomic shocks, it proves they have incredible financial discipline and a structurally sound business model.
So it's not just about the cash.
No, it's a proxy for corporate quality.
Now, compare that passive structural approach to active investing. Active investing is when you're trying to beat the market by reading balance sheets, predicting consumer trends, or timing earnings calls.
Right.
Now, if you were a multi-billion-dollar hedge fund with algorithmic advantages, sure, you might have an edge. But for the retail investor listening to this,
If your version of active investing is reacting to a Reddit thread or buying whatever ticker is currently trending on social media, you are going to be systemically stripped of your wealth.
definitely.
By the time a stock tip reaches the retail consensus on Twitter, the institutional money has already made their move. The opportunity has evaporated. Profit is made at the point of purchase, not at the point of sale.
That makes sense.
You win based on acquiring the asset below its intrinsic value. If you're buying into hype, you're inherently overpaying.
Which brings us to the ultimate behavioral stress test of this entire mathematical architecture. We have the automated infrastructure we know to buy broad passive index funds to capture profit. But all of this flawless math instantly vaporizes if you fail to adhere to one critical behavioral principle when the system inevitably shocks you.
Yes, the golden rule of wealth building: always be buying. Every week, every month, without exception, completely independent of how the macroeconomic environment feels on any given day.
Because the historical reality is completely unavoidable. Over the last 100 years of U.S. market history, there have been more than 25 significant market crashes.
That's an average of more than 2 major, terrifying crashes every single decade.
They are not anomalies. They are not glitches in the matrix. They are built-in features of the capitalist system.
Exactly. They are the mechanism by which excess leverage is flushed out of the market.
So what does this all mean? How do you actually execute the math and fight the biological evolutionary urge to panic when you turn on the news and the anchors are screaming about a historic recession and flashing red graphics every 30 seconds?
Well, what's fascinating here is the advanced behavioral psychology of the wealthy. They recognize that their own amygdala, their brain's fear center, is a terrible portfolio manager.
That's a great way to put it.
People who build generational wealth don't use magic to time the market. They use math, and they execute it with ruthless, emotionless consistency. We have to completely reframe what a market crash actually is structurally. When the S&P 500 drops 20%, it is not a crisis.
It's a 20% off sale.
Yeah.
It's a discount window on the exact same fundamentally profitable companies you were happily paying full price for 3 weeks ago.
Exactly. Think about the absurdity of human behavior in financial markets. If a luxury car dealership drops the price of a vehicle by 20%, people line up around the block to buy it.
Oh, absolutely.
But when the stock market drops the price of the 500 best companies in the world by 20%, people panic and demand to sell their shares. It's the only marketplace on earth where consumers sprint out of the store when the items go on sale.
They literally buy high and sell low out of pure fear.
And selling at the bottom is mathematically catastrophic because it permanently destroys your compounding base. You cannot participate in the inevitable recovery if you liquidated all your assets at the bottom of the crash.
Right.
The disciplined investor sees the red on the screen and recognizes the discount window is open. They let the automated purchases run. If they have excess capital in reserve, they actually accelerate their buying.
The entire game is long-term participation. Do not let temporary emotional panic be the most expensive luxury you ever indulge in.
You just stay in the seat.
So let's pull all of this together. We've mapped out the entire architecture. You have the rigid 75-15-10 distribution. You understand the necessity of setting up three distinct bank accounts to eliminate mental accounting errors.
Right.
You have to automate the routing to bypass your 11 p.m. decision fatigue. To deploy the capital passively into broad market ETFs to capture fractional profit, and to never, ever interrupt the compounding process when the market crashes.
The theory is flawless. The only variable remaining in the equation is your execution.
And this is where the absolute urgency of this entire discussion comes into play. Because human nature dictates that most people will hear this, they'll get a quick hit of dopamine, they'll feel incredibly motivated for about an hour, and then
And then they'll quietly tell themselves they'll set all this up next month.
exactly, when things calm down at work.
Mhm.
But next month is just indefinite procrastination, dressed up as a responsible intention. A flawed, imperfect system that is physically running today will mathematically destroy a perfect theoretical system that only exists in your imagination.
If you genuinely want to alter your financial trajectory, the physical infrastructure has to be built today. The friction has to be eliminated immediately. You log online and open the second and third checking accounts today.
You go into your employer's HR portal and adjust your direct deposit routing today.
You open the brokerage account and establish the recurring VTI or SPY purchase today.
Until you actually change the plumbing of your cash flow, you are still just a well-paid hamster powering someone else's profit machine.
Which brings us to a final, slightly more philosophical point we want you to really mull over as you audit your own accounts this week.
Let's hear.
If you actually implement this 75-15-10 architecture and you let automation do the heavy lifting for a decade or two, you are eventually going to cross a mathematical threshold.
The crossover point.
Exactly. There come a definitive day where the compounding profit from your investments begins generating more monthly cash flow than your actual day job.
Oh.
And when that structural shift occurs and your labor is no longer required for your survival, how will that alter your fundamental definition of work?
It's the ultimate question. Once you are no longer a hostage to the paycheck, once you finally step off that treadmill and realize you are holding the controls to your own machine, what will you actually choose to do with the reclaimed hours of your life?